Sandy Pomeroy, Neuberger, Berman Senior Portfolio Manager, joins us now. Why would I want to be in a dividend stock when I can be in a money market fund or a lot of the fixed income assets right now that are paying much higher yields? We've got some competition.
I totally hear what you're saying, and I think most people are running through that calculus as they think about where to put their money right now. But the thing is that dividend stocks grow their dividends, where Treasuries, you get one coupon, you have the coupon for the duration of the bond, and that's it. So if you think about what a bond that's yielding 4% can give you over a 5-year period, if you can find a dividend stock that's paying 3% and is growing their dividend at 10%, you're going to end up ahead over a 5-year period of time. Now, if you add inflation into the mix, you're actually going to be better off because many of these companies have pricing power, and they're going to be able to price their product, their profits are going to go up in line with what inflation is. And so you become ahead of the game where you won't in a fixed income security.
It makes total sense, but it's not the way the market is looking at it right now. So do you need to see a reversal in rates for dividend stocks to work?
That's an interesting question. And I don't really know if that's the case or not. They are so cheap right now that maybe you just have a reversal based on the fact that they are as cheap as they've been since the tech boom of the 1990s. And when we did that, we were 3 standard deviations cheap relative to that period. We're 3 standard deviations cheap now. And they went on to have a great decade. They were the outperformers for the next 10 years. And that could happen again in our mind.
On what metrics are they cheap? How do you do that analysis? And I also wonder what sectors tend to surface as being more attractive on those bases.
What sectors within the income-paying stocks? So the ones that we like are ones that not only have a valuation component, cheap, but also have growth potential. And in our mind, the biggest opportunity here is in industrials. And that's where we have our largest overweight, relative to the market. They have an opportunity to grow, mostly based on the fact that we have an infrastructure boom going on. We have investment taking place because of the IRA. And we also have just really rickety infrastructure all over this country that needs to be rebuilt. And so we think many of these companies, like Cat, like Deere, like Eaton, are going to be beneficiaries of that. And those are where we have most of our, from a sector bet perspective.
I wonder how you think about how old an investor needs to be to really emphasize this in their portfolio. And how young could you be and still pay serious attention to dividend growing stocks?
Yeah, I think it's part of an asset allocation. And I understand the logic on why a young person would want to be in something that's got a little bit more growth potential and whatnot. But the valuation of growth stocks is so high relative to the valuation of dividend stocks that I think there's an opportunity for all ages. And when you think about an overall asset allocation, having a little bit of defensiveness in the portfolio makes a lot of sense. And we think of this strategy as being more defensive than the overall market. So if you look at last year, for example, the market was down, call it 18, 20%. We were down 4%. So, in a market that goes down a lot, this offers some protection. And we participate in the upside. We just don't have the juice that being in the, really high flyers provides.